The UK's bond yields have been ground lower and lower in recent years, despite the dismal state of the government finances. Investors have preferred the relative safety of UK gilts over many of the alternatives, and combined with the Bank of England's quantitative easing, this has pushed benchmark borrowing costs to record lows. Should the Chancellor, George Osborne, be taking advantage of this to delay some budget cuts, or even try an investment spree to kickstart growth once more? Or should the focus remain on getting the deficit under control? With me to discuss this is Alan Wilde, Fixed Income Head and Currencies Chief at Barings Asset Management. Alan, thank you very much for being here today.
Good morning.
We have this chart showing the UK 10-year gilt yields. As we can see, we've been edging up recently, but they're still fantastically low compared to the historical average. I mean, what's this really saying? How are the markets perceiving the UK's creditworthiness?
Well, I think the first thing to say is that the UK has been a direct beneficiary of all the uncertainty in the world, primarily in the euro area. So there's no question in my mind that the gilt market has provided some safe haven opportunities for international investors who have been obviously troubled by developments within the Eurozone. Furthermore, the coalition government have rigorously pursued their fiscal deficit reduction plans, and so far that has played well with gilt market participants.
But this little edge up here towards the end, I mean, what's that really saying? Is that just purely things look a little bit better in Eurozone and there's a natural backup in gilt yields?
Well, if you do look at the timing of the chart, it's not a coincidence that it does tell you that the situation in Europe with the latest round of ECB measures, together with what the Fed did last week, has coincided with a backup in developed market bond yields. So I wouldn't read too much into this specifically for the UK. The market has moved pretty much in line with bond yields over the last few weeks.
So we shouldn't start worrying about sort of spiralling UK borrowing costs. I mean, does this give the UK a bit more scope to maybe backtrack a little bit on the austerity? I mean, growth is going nowhere in a hurry, and that's a charitable way to put it.
Yes. Well, obviously, there has been some discussion in the markets about the fiscal programme. The borrowing costs the borrowing requirement remains very high. Growth remains very weak in the UK. So you could infer from that movement in yields that the markets are becoming a little troubled at the deficit reduction plans. But I think there's many moving parts to this. I think the interesting situation that may provide some scope for the Chancellor is that the discussion seems to have moved within the gilt market towards tolerating a higher level of borrowing as a means to stimulating the economy. And I think most market participants would acknowledge that if you don't get nominal GDP growth over the next few years, then the deficit reduction plans are not going to be met. So there is a balancing act, as always, between a little bit of extra impetus into the economy and some toleration of higher borrowing requirement in the short term.
Well, if we turn to the UK inflation-linked gilt market, that has obviously not been quite as sanguine recently. We can see here the yields for the 2062 inflation-linked bond spiking quite dramatically since mid-September. I presume this is the fact that they've launched this consultation about the index, this retail price index that underlie the inflation-linked bonds. I mean, how concerned are people about this, that they might scrap that index altogether?
Well, I'm tempted to say that with this movement back up in real yields, the market probably has already discounted the worst situation, which would be to converge the RPI and CPI measures. So market participants, I think, are mindful that that's the worst case outcome. Remember, this is still a consultation and it's by no means concluded. The backup in yields, however, is not dissimilar to what we've seen in other markets. Now, the question is whether the UK has moved differently to other markets because of this particular issue with regard to the RPI calculation, or whether real yields generally and break-evens in particular have moved in a way which reflects the quantitative easing programs that we've seen announced by central banks around the world. And I think probably inevitably it's a combination of the two. The disappointing feature yesterday at the auction was that there was sufficient cover for the bond, but the aftermarket was very weak. So maybe we're beginning to test the boundaries of appetite for real yield instruments at current yield levels.
Well, Alan Wilde, thank you very much for being here today. It will be interesting to see what comes from the proposed changes to the RPI. The index clearly has weaknesses and should be made fit for purpose. The question is how to balance this with the understandable concerns of investors. George Osborne will probably have a tricky choice on his hands next year when the consultation ends.